What you're about to see is Switzer TV property, which is shown on Thursdays on our YouTube channel. And this is the show where we try to make you an expert on property, and we do that by seeking out the experts who can make you exactly that. On tonight's show, Andrew Wilson from My Housing Market tells us why the Australian property market is different from all others, which will really annoy a lot of doomsday merchants out there who think that we have to have a bubble that bursts. Then Joe Masters, the EY Oceania chief economist, will look at the economic setting and how that might affect house prices going forward. And finally, real estate expert from News Corp, Tom Panos, will talk about what he sees in the market going forward and where are the best places to be investing your money in the property market. That's the show, so without any further ado, let's go and catch up with Andrew Wilson. My first guest is Dr. Andrew Wilson, who is the chief economist at My Housing Market, formerly of Domain. How are you, mate?
I'm good, Peter. How are you?
Very good. Now, you're with Domain for what, at least 8 years?
8 years, yes.
Yeah,
APM, then Domain, or part of the Fairfax Group.
Yeah. And you saw the market go through what some people like to call a bubble, and then the deflation of that bubble. Yeah. And we've now seen a recovery in the market. Yeah. Andrew, would you have expected the comeback to be so quick?
Well, look, I always expected the comeback to come back, Peter. The underlying drivers of our capital city markets, by and large, are always in favour of demand over supply in the medium to longer term.
Yep.
And of course, when we did have those cuts to interest rates that commenced in 2012, you know, the attempt by the Reserve Bank to reinflate the economy after the end of the mining boom, we obviously had a very strong response from our housing markets. House price growth in Melbourne and Sydney for a few years there was over 10% per annum. And of course, it was a release, I guess, of that interest rate energy once we got down to those record lows. It wasn't across the board the prices growth. Other capital city markets, of course, prices were a reflection of local supply and demand factors, but certainly Melbourne and Sydney, on the back of strong migration particularly, had a very strong period then. And look, I think that's when it all started to go pear-shaped. The Reserve Bank and APRA sort of bought into that bubble theory argument and tried to get ahead of the curve in terms of easing what they thought was over-investment, particularly from small investors in property, particularly in Sydney. We had a very high proportion of investor activity, which you do get when prices rise at that rate. It's a very attractive proposition for speculating investors, and of course it feeds price growth, because the higher the prices go, the more investors get interested, then prices go higher. And of course that was just a process that we should have really been quite relaxed about, because it would have dissipated eventually, because that price growth capacity is not infinite. I mean, it does have barriers around it, and that of course is low interest rates and incomes growth. However, we did get that incursion into the market from APRA. And the Reserve Bank, I feel, perhaps turned the tap off in terms of more lower rates as a result of concerns over what was happening, particularly in the Sydney market. And then it's sort of all gone pear-shaped since then. And I think the lesson is always that, we're very fortunate in this country to have a robust and resilient housing markets, and it is a product of our banking system. We have, of course, the big four banking environment, which is a very strong oligopoly. But that means that even though they have that very strong market power, that they don't take risks in their lending environment reflective of the market, as we saw in the US when prices start rising and it's a heady market environment. Then factors such as LVRs and income requirements, that starts to loosen as banks or financial institutions look for a stronger market share. And that's fine as long as prices are rising, but once they start to fall, you're then exposed to issues such as defaults and falling prices. Now in Australia, we don't have that same market focus from our big four, because they don't have to take risks, because they still make very strong profits regardless of market conditions, more or less. So it's a good thing, because it stops the individual buyer taking risks as they would in a rising market. The banks will still maintain that sort of 80-20 LVR and the restrictions on incomes. And I think that we needed to have a bit more faith in that going forward, and watch and wait for the market to eventually dissipate from that lower interest rate energy. But of course, the interference actually meant that, in a way, it became a self-fulfilling risk management activity, because the risk was that, you know, rates would rise and prices would fall. But rates rose, but it was through that credit squeeze from APRA. And of course, prices fell, and confidence really fled the market at the time, and we had that significant price decline.
Was it a bubble?
No, it's not a bubble. I don't believe the bubble.
It was just a boom.
It's sort of a, well, it was a boom, but certainly the factors that generated the boom were clearly the cut in interest rates. I mean, as interest rates fall, it makes property more affordable, because with a given income you can pay more because your interest rate is lower. And that's the whole point about having these boundaries around our lending environment, which is very fortunate, and we're very fortunate to have them in Australia. It meant that, as I said, that we could you know, have more of a confident outlook in terms of where the market would track. I mean, we've never had a bubble environment, which of course is when you start to see the cycle form as a bubble, when you see the previous trough point being I guess, lower, or the current trough point being lower than the previous trough point, that gets that bubble shape. But typically our cycle has an upward trend where we start to recover above the previous trough point. And this has, of course, happened now. But what's happening now is we're seeing a release of that pent-up demand that was sort of dammed up with that credit squeeze that APRA put on.
Could we solve the fact that prices are rising rapidly and pricing a lot of people out of the market by simply improving the supply
Absolutely.
Of properties?
Yeah, and look, this is a double-edged sword, Peter, because we've got now significant concerns from the Reserve Bank as to the state of the economy. They're scratching their head as to, you know, what they say is they don't understand what's happening, what the forces are now that we're looking towards. Obviously, the unemployment rate is now rising. Jobs growth is still reasonably active, but you know, the supply side issue is clearly and I've always said that, is clearly the solution to, you know, a moderating prices growth, because it's just the simple foundation of all economic supply and demand. But the point that we've had now is that because we had those restrictions to credit, which spooked the market, we've now seen a virtual collapse in new construction coming through, particularly for apartments. Now, that's a very labour-intensive part of the economy, and we need as much labour intensity sectors up and running as we can get. You know, we're suffering from the change in retail, mining's booming, but it doesn't have the same productivity levels or labour intensity in mining that we do get in the construction sector. Now that's going to take a while to ramp up. So it's become sort of self-perpetuating, and we need to, you know, start really focusing on supply side issues, you know, as being the main game, and understanding that interest rates will manage the demand side, given how rigid our lending environment is. But
you're an economist, and you would have seen the argument by the doomsday merchants out there. You know, and of course you were working at Fairfax when they were running with headlines 40%
That's
house
right.
price. Well, you must have rang them up and said, "You guys are going to be kidding to believe that kind of thing," or what?
Well, look, you know, we have a very robust housing market, Peter, and it's underscored really by what Australians have a very strong connection to home ownership and home investment. As a wealth generator, it's a very strong cultural tick that we have in this country. So, of course, when you see headlines that are promoting a catastrophic fall in prices, you certainly want to read all about that, right? But
you must have argued with him, given your background. You must have said, we're going to have a very serious recession and a big rise in unemployment for a 40% fall.
Well, look, the interesting thing, Peter, is that to get those sort of declines, which we've never had before, we would have had to have an extraordinary rise in interest rates. I mean, the unemployment, the economy usually is a relatively side issue when it comes to the housing market. Now, the recession in 91, 92, which was our, I guess, most current economic shock, unemployment double figure, you know, and particularly in Victoria, it was a very tough environment there in terms of the economy. And yet housing markets kept ticking over, because we've got to remember we had 17% interest rates in those days. It was a different environment in terms of lending criteria. But really, housing markets generally took that in their stride. So unemployment, yes, look, it's a tough gig generally for the economy, but it doesn't have the same impact on the housing market as issues such as higher interest rates do, because that's typically the driving force to push prices downwards. And of course, higher interest rates would only have come if we had have had a booming economy, out of control inflation, or a currency crisis.
Okay. Now,
So it was never going to happen.
No. I'm going to ask this question because I was torn apart by the Twitter sphere for actually arguing, I don't think house prices will fall by 40%. I said 15 to 20, I can see that because, the market really got ahead of itself, blah, 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 blah. But a lot of these people say, if you look at what happened in Spain, what happened in America, happened in Ireland, they seem to think that these real estate markets are just interchangeable.
That's right.
Whatever happened, it has to happen here.
That's my point.
And we are kidding ourselves if we think we're different.
Well, we are.
Okay.
That's the point.
You're an economist, and because you're going to take the heat, and I'll run the fact that you're actually saying this.
Absolutely.
Yeah, but you're saying we are different.
Absolutely.
How are we different?
Well, our finance sector, as I spoke about before, is completely different. We have a very strong finance sector in terms of it being highly risk averse because it has this very strong market power. So it doesn't have to take risks. So market forces don't drive the lending criteria for Joe Lender out there as the market rises. So look, that's a positive, which isn't common to other.
Got any more?
Well, obviously our supply side as well. I mean, we have state governments typically are in charge of planning, of land planning. There are constraints to supply because of that. Not in my backyard, we see a lot of because we only have a small amount of significant urban centres, but there still is roadblocks to higher density, particularly in middle ring suburbs. So we constrain, supply is constrained because of our individual nature of our planning environment.
And those markets I talked about all had oversupply, didn't they? The US,
that's right.
China, Spain, Ireland, they all had oversupply.
Well, this is the thing. We should be celebrating the balance in our markets that we have, and I think we've got it really right here. And I think that what we see, and that's what we saw in the downturn, in a sense was a response to sentiment rather than the fundamentals. And as I said through that whole period, when it was 40% whatever, that the fundamentals remain strong. Demand remains ahead of supply in our housing markets over the medium to longer term. And of course, we have this very strong aspiration for home ownership and a very significant sense that wealth creation is through a home investment or residential investment as small-scale private investors. Of course, 40% of our housing stock is supplied by private investors. That's again different to what we see overseas, where there's a lot of government involvement in housing, providing housing.
The fact that our loans are all loans where people have to actually pay them back.
Exactly.
Is that as significant as apparently some states in America,
they
actually...
No recourse, full recourse, Well, we have full recourse, so that means that banks will chase you to the end of the earth.
That's right.
To get what you owe, even if it costs them more, to get the money back that you owe them. And people, look, I think there's also a stigma involved in mortgage defaulting, and I think one of the strongest lessons we learnt from the recession, and it was what the then commercial banks, with the non-government banks at the time, became focused on, was that Australians will do anything to hang on to their house. And I think
sell their grandmother into captivity.
They'll do anything to hang on to the house. And it's not just the financial benefits of it, because and that's another thing, we've evolved because of our significant attachment to housing, home ownership. We've evolved taxation rules that emphasise that highlight that, which are different to overseas again. So it's all working in favour of being a homeowner or a home investor. And as I said, that's aspiration strong. All we have to do is see a new benefit or a change to a first home buyer scheme to see how it releases energy, because people are, are waiting and in the queue to get into the housing market.
So the summary is, Andrew, doomsday merchants won't get their day of reckoning and substantial collapse.
But I don't think they want that, Peter.
They do. The doomsday merchants want it because they want.
Oh, they're the real ones. Yeah, you mean the nutters?
They're either investing in gold, or they believe Steve Keen in 2009 sold their house and they're waiting for a buying opportunity.
Yeah, well, they'll be waiting a long time. But look, as I said, Peter, I think we should celebrate what is a remarkably robust and resilient housing market. We are world leaders. Maybe it's accidental, maybe it's not, but we certainly are not a hostage to the extreme commentary and the extreme predictions that come and go in our market. And perhaps, as I said, they do get resonance because people are so connected to our housing markets that they need to take attention to it. But in the medium to longer term, it all balances out, and that's what we're seeing now, Peter. And this is a validation of how our system works. Is we're now seeing the ship getting righted again after a pretty rough ride. from a scary period, and it was a fear-driven market, let's face it, and it's now obviously being pushed along by lower interest rates, as it always is.
And you don't make any more money whether the market's going up or going down. You're not a spruiker.
Well,
I can't accuse you of being a spruker.
Well, I'm just.
They will, of course.
I'm not. I'm not a professional property investor. I'm just. I look at myself as a
humble
economist
who follows the property market.
Well, just an old teacher still teaching, and it'll never come out of me. But look, as I said, I think that the thing that really concerned me through this recent period was it's one thing to have the doomsayers and the negative Nellies sort of attaching themselves to the usual theories, but this time we unfortunately got a buy-in from our regulators, from the Reserve Bank and from APRA, and I think that was what's actually caused a lot of problems for the Reserve Bank now. It's turned off the tap for residential construction, and they're now really, really concerned that we're not going to see the full employment environment that they want with lower interest rates, and that was because of those interferences in the marketplace, because they didn't have confidence that the market would eventually ease itself from strong prices growth in Sydney and Melbourne through that 15 to 17 period. And now we've got this situation where the macro economy is the problem, and they don't care about the housing market anymore, because at the end of the day, the Reserve Bank's job is the macro economy, not to worry about theories about housing market bubbles.
Okay, Andrew.
All right, thank you, Peter.
Dr. Andrew Wilson. Dr. Andrew Wilson, and as I said, not a spruiker, just a humble economist.
That's just a humble.
Everyone's really happy to see that the house price fall is over and the housing sector is looking a little bit more healthy. I'm going to talk to the Chief Economist at EY Oceania, Joe Masters, to see, is the outlook on the improve or should we keep our fingers crossed? Joe, thanks for joining us.
My pleasure.
Joe, house prices were falling pretty aggressively from the middle of 2017 through 18, and there were calls out there that we could see a 40% fall in house prices. I fought against it and got hammered on Twitter, but so I'm kind of hoping that the worst is over. What do you think?
Look, I think the worst is over. Clearly sentiment has turned. Now there's a few things that were behind that. Obviously the election outcome. We've also seen back-to-back rate cuts from the Reserve Bank and a few other movements as well. So we've seen auction clearance rates clearly improve. We're now seeing house prices rise in a monthly sense, and particularly in Melbourne and Sydney, which drove those falls. So it does seem like that precipitous decline that people were worried about isn't going to eventuate, and the market is finding some new equilibrium.
Okay. Look, when I was looking at the reasons why the market might be improving, I came up with, I created like a test, a multiple choice test, which I thought might make it easy for you, okay? Not that you need it, because you're brilliant anyway, but I've got to say, I've always thought myself brilliant, but multiple choice tests sometimes found me out for some inexplicable reason. So I've got so why have things improved? Rate cuts, you covered that. Bank lending has improved. I thought it was quite restrictive before. Tax cuts, the election win, and no bill shorten policies, which were quite scary in terms of negative gearing.
Yeah, absolutely.
Or all of the above?
Look, I think all of the above. I'm less clear that changes in bank lending has really driven the recovery. We've seen a very significant tightening in the availability of credit, partly from macroprudential measures, partly through the Royal Commission. There is, I think, some sense that that tightening is behind us, and that's probably true. But I'm not sure that we're going to see credit become easier again. And even the introduction of comprehensive credit reporting just this week actually has the potential to tighten further credit for some borrowers. So I think we're not seeing any further aggressive tightening in the availability of credit, but we're not seeing it ease off really either.
Okay. The next question to worry about is, could what we're seeing now lead to a re-ignition of the boom, and therefore some people would call it the bubble? Does the bubble get bigger? What do you think?
Yeah, look, I think there is some risk of that. I mean, we've seen quite a sharp turnaround. Prices in Sydney and Melbourne rose over 1% last month. So if you think about that annualised, that gives you a 12% gain. And obviously there's some concern as we're sort of cutting interest rates that we are building that speculative bubble down the track. I'm not convinced, though, that we will see a V-shaped recovery. A few reasons for that. The first one is, at the moment, the volume of sales going through is still relatively low.
Yep.
Now, as prices stabilise, as they rise, and also given that we're coming into spring, that we'd expect to see more people put their homes on the market. So that will, I think, moderate the monthly rises that we've seen. The second one is that as prices rise, you lose a bit of housing affordability. And one of the parts of the market that's really driven this turnaround has been first home buyers. So there is, at some point, again, affordability becomes an issue for them. But the third one's probably the most important one, and that's there are two factors that drove such big house price gains over the last 10 or 15 years that we won't see again. And that is that we had that deregulation in our financial markets through the 80s and early 90s, which feels like a long time ago, but that really opened up access to credit in a way that we hadn't seen before and we're not going to see again. And the second one, of course, is that mortgage rates fell from whatever the high was, 17% to sort of 4%. We're not going to see that again. You can go from 4 maybe to 2, but you're not going to see such a big reduction in interest rates. And those two factors were part of what was behind such sharp price increases.
Okay. As you can see, I'm dealing with all the scary issues that doomsday merchants think will come back to bite us. And one they always refer to is Australia's level of household debt compared to GDP. I think we're the second highest in the world behind Switzerland. Or if not, we might have passed them. Now, the doomsday merchants believe that the only way this will be sorted out will be through a day of reckoning and ultimately a very serious recession. Is that necessarily the only way we can sort this out?
I don't think it's the only way. It is a way that we've seen in the past. And of course, Australia escaped a recession during the GFC. So if you think about the US household sector, they deleveraged post GFC. So we didn't have that. So we've had this very long economic expansion, household debt now very high. But we also know that serviceability looks okay because interest rates are so low, right? Yes, I'm holding a big stock of debt, but actually I can service that. And it doesn't look like we're going to see higher rates anytime soon, or sharply higher rates anytime soon. So as long as interest rates stay low, one of the things we have seen Australian households do is, by and large, when rates get cut, they keep their mortgage repayment the same. So actually most mortgages are well and truly ahead of their scheduled repayments. And I think that helps to mitigate some of that risk from the stock of debt that we're holding. And the longer that goes on, the more that we kind of get ahead in our mortgage payments and pay down principal. Yeah,
and I've been told that some of the statistics that we see actually don't take into account those buffers that have been built into people's actual loans, that they take out the actual loan compared to GDP rather than what is the net debt, because they've got such a buffer built up in their mortgage.
That's right. So it depends on the statistic that you're looking at, and it depends whether you're looking at scheduled repayments, which include already some principal repayment, or actual repayments. So you do need to be a little bit careful, but there is some Reserve Bank data that shows that a vast majority of mortgages are well and truly ahead of repayment. I think it's about 2 years ahead of repayment. And when you think about, I think there's about a third that are not ahead of their repayments, but a big portion of those are either new loans where you haven't had a chance to get ahead, but also, of course, investor loans where the tax system doesn't encourage you to repay principal. So we need to bear that in mind too.
Okay. So what is your global view? Because it seems to me that if something is going to force interest rates up, it could be some kind of credit squeeze, a bit like the GFC, where banks no longer trusted each other. So to get money, they actually raised interest rates at a time when a recession was basically coming. It didn't last long, but basically until the banks would trust each other, there was that kind of period where interest rates actually went up. Can you see that happening in the short term?
I think it's unlikely. As you said, we did have that short period of congestion in the financial system, But I think we've also learnt a lot from the GFC experience, both here in Australia and offshore. So my guess is that the central bank would be very quick to move to restore liquidity in the system. And when you restore liquidity, you restore trust. Now, we did see that in Australia post-GFC, but I think if we got hit again, you would see that much, much faster come through the system.
And this is the point I want to make, because you've been an economist for a long time.
Yes.
And you've lived through some of the things that I was reporting on over that period of time. And someone asked me a question recently about, are you worried? So, similar question I just asked you there. And I said, I can never remember a period of time where central banks were actually in there doing stuff before the you-know-what hit the fan. They tended to wait, and I remember in the GFC, I wrote a story in The Australian in February of 2008 after listening to a lady by the name of Philippa Malgrim from the Canterbury Group in London, who actually said, well, I asked her about our Reserve Bank, they were raising interest rates in 2000, and I said, should they be cutting? She said, your central bank will have to turn on a dime and cut. That was February. They waited till September, but they were the first central bank to actually cut. They woke up before everybody else, but they waited a long time. Current central banks just seem to be right in the middle of this. ECB, negative interest rates, a threatening QE, all that sort of stuff. And that seems to be very different than any other period of time that I've experienced central banks.
I think that's exactly right. And I think a lot of that is because monetary policy globally is already reaching its natural limits. So, I mean, there's sort of two schools of thought, right? One says if you don't have a lot of firepower left, go early, go hard, and try and get ahead of the cycle. The other economists would argue if you don't have much firepower left, wait until you really, really need it. I think what you're seeing is the fact that central banks are sitting in that former camp. They're aware there aren't that sort of that much further that interest rates can fall, so they're trying to get ahead of the curve. I think also it's important to remember that we've had this unconventional monetary policy response post-GFC, and we call it unconventional for a reason, right? We've never seen it before, even in long careers. And that experiment's not over yet. We haven't got a single central bank that implemented QE or negative interest rates that has totally unwound that experiment. So as the world starts to slow, as uncertainty picks up, geopolitical tensions, not only is monetary policy at its limit, but we're kind of in the middle of this experiment. So I think central banks are playing a very, trying to be very proactive and try and get ahead of that curve.
Okay, let me give you a chance just to be personal here rather than, talking on behalf of your employer or whatever. As an economist, are you hoping that governments start to use fiscal policy going forward to take the pressure off monetary policy?
Absolutely. From my perspective, the economy has lost a lot of momentum. We've lost it very, very quickly. The growth base is narrowed. In the first half of this year, if you take out net exports and public spending, there was no growth. And the global environment's much more difficult. We hear Governor Lowe consistently saying monetary policy can't do it all. We know from offshore experience that things like negative interest rates have unintended consequences. If you think about Australia's banking system, it's quite challenging for our banking system to absorb that. And also we're not getting the currency push that we would normally get, right? Because other central banks are also easing. So we're not getting that same buffer that we got actually after the GFC. So when you think about those policy levers and you think about the economy, fiscal policy has to play a role in that. Now, the government is committed to this surplus in 2019-2020. That seems to be, at the moment at least, sort of bedded down, which limits your policy response. And the conversation obviously now around infrastructure, around productivity measures, that has to be part of the conversation. But I think if we get hit from a serious shock from outside, we're really going to have to stimulate our consumer.
Yeah, and in many ways, Joe, we economists know that in trying to get a surplus, if you at the same time caught low economic growth, you end up with a deficit anyway, don't you?
Look, absolutely. And also you've got this unusual period at the moment where monetary policy is easing and essentially fiscal policy is tightening. Now, I know we've had tax cuts, but when you're moving from a deficit to a surplus, you are tightening your fiscal policy at a time when monetary policy is trying to ease and support the economy. So that dilemma, I think, is an issue as well.
Joe, thanks for joining us.
My pleasure.
That's Joe Masters from EY. My next guest is one person who knows more about real estate than most people I know. Tom Panos, thanks for joining us, mate.
Hey Peter, how you going?
Excellent, mate. Now, position yourself for my audience so they know where you come from.
Okay, so the main thing I do is train the real estate industry on best practice, marketing. I work for News Corporation doing certain works, analysing the real estate markets. And generally speaking, on a Saturday, I'll do about 10 or 12 real estate auctions myself in my auction company. So I'm very connected. Everything is aligned to the real estate industry.
Yeah, and basically you live and breathe real estate, don't you?
Oh, look, it's 70, 80 hours of work that it's either with the real estate agents, it's either with consumers, it's either working with strategy, with News Corporation. I love it. And I've got to tell you, all of a sudden, real estate's got exciting again, back particularly in Sydney and Melbourne.
Okay. 2 years ago, the newspapers, even your own beloved newspapers, were carrying stories of a possible 40% fall in house prices. Did you ever believe that, Tom?
I didn't believe it was going to be 40%, but I did believe that there was going to be a correction because I could, Peter, I could feel it. Even on a Saturday where you actually got the pulse rate of a vendor out there on auctions, I could tell they were sort of saying, hey, I'm not going to get carried away. I'll look at the next one. So I saw a tendency that fear of missing out started to leave through the veins of buyers. Now, I didn't think it would be 40% because for the average person, say in Sydney, that meant a $1 million asset was going to go down to being 600. And my experience, Peter, is that as long as people have got jobs, if they can't get $1 million, they might sell it at 900, but they're not selling it at 600. They'll say, I'll hang on to it. We've got quite different laws in Australia that mean that you can't simply just go hand the keys like we'd seen in other parts of the world, example, the USA a few years back, where people don't care what it sells for. In Australia, people do care what it sells for and they would hang on to it.
I know in that period around late 2016, early 2017, my son was looking for a house in Paran in Melbourne, and we went to 4 auctions, no bids. And I knew this market was going to be in trouble. And I knew also that the sellers were just simply asking a price that had been determined by the boom period.
Correct.
And the buyers were in a position of strength. Well, I think Al ended up getting a place probably 300,000 less than it had been.
Yeah.
But the price had been inflated by an enormous amount in the previous 3 or 4 years.
Correct. So he was obviously one of the people that have benefited out of predominantly has been a Sydney-Melbourne correction.
Yeah.
And he's probably seen some gains even in the last month or two.
Okay, so tell us what you're feeling, because we read it on Monday when the auction clearance rates are coming through, but what's the pulse that you're feeling at the moment?
Fear of missing out's come back into Sydney and Melbourne. And we've seen clearance rates now hovering around 80%. I have to say to you, I left and went overseas for 2 months in June and July. And I got back here and I auctioned on the 22nd of July and it was like 2 different worlds. It appeared that whilst I was away, a federal election and a change of appetite from banks had meant that all of a sudden, when I drive up to an auction on a Saturday, the street was full of cars again. And I said to the agent, the first one was in Newtown, and I said to the agent, this one's a good one. And he said, Tom, it looks like they'll all be good today. The buyers are back. That was on the 22nd of July. I still remember it. And I think, Peter, overall, if I had to give you a rough high-level estimate, Melbourne saw a drop of approximately 10 to 15%. And I think that it's picked up 5 or 7% in the last 2 months, roughly. And Sydney would have seen in some markets it hadn't gone down 40%.
Yeah.
So I think that was all rubbish, right? And there's been plenty of people. I mean, one guy I think 6 years ago, who was a professor, was adamant that
Steve Keen.
Steve Keen.
Yeah.
That's him. That's right, Steve Keen. He actually put a bet on saying that he was so sure. In fact, he sold his own property in fear that it was. So I did expect that your son would buy a property cheaper, but I didn't, never thought it'd be 40%. But in the end, it ended up being around 15 to 20% in Sydney, Melbourne. Yeah. If you bought a house in Sydney in the last 18 months on a $1 million property, it's probably now worth 1.1.
Given what you're seeing right now, Where do you think this is going to go? Do you think spring will bring more supply and that might contain the price rises and we won't go back to the fear of a big bad bubble?
I think we're going to have a spring that will actually become a late spring, early summer. And I believe that while stock levels, Peter, have remained better than the winter period, but lower year on year versus other spring years. So we're looking at the early part of spring, we've got lower stock levels. Fear of missing out is being caused by low stock levels. It appears that real estate agents have started to say, hey, whilst we haven't got the listings, we have got the market appraisals. And the market appraisal is the first step to a property coming on the market. So you and your wife call an agent over and say, what do you think it's worth? And they say, oh, it's worth about 1.5 mil. And you say, okay, let me think about it. And then over the next 4 to 6 weeks, you go off, get your contract ready, get your paperwork ready, get someone to sort of tidy it up, and you'll probably hit the market in November. So I think a real testing period for the market will be November, December, because we're going to have stock levels that are going to increase, and that is going to take the pressure off what we've seen in the last 4 to 6 weeks.
I would have thought, and obviously I want you to correct me if I'm wrong, that during that period where people who were trying to sell got disappointed, they might have then put their place out for rental.
Yeah.
And so those people are locked into a contract.
Yeah.
But eventually that contract, if it's a 1-year contract, goes off the boil, and then those people might put it on the market. Will there be a bit of that going on? You reckon?
I think there was a small group of people that said, if we don't sell it, we'll rent it.
Yeah.
Some of those people entered 6-month leases. Some of those people entered 12-month leases. And I think that there's a lot of those people that are waiting for the lease to come close to an end, because you can actually sell it with a lease in place, because the whole process will take a few months by the time settlement. So you are right. And I think that they're going to be some of the ones that we're going to see in October, November.
Okay. Looking around the country, where are the best places to buy? Because for a long time we've been saying that Queensland, southeast Queensland is going to come good, and it's been okay but not great.
Yeah.
Are you seeing any trends that suggest southeast Queensland's on the rise?
Yes, I think southeast Queensland. The issue, it's an interesting question, Peter, because I think the answer is different for different people. If at the moment you're somebody who cares more about capital growth, that wants to actually say, hey, listen, I'm prepared to hang in there a bit, but I want to see chunks of hundreds of thousands of dollars increase in the value of my property. I would say there's still value in Sydney and Melbourne because the price correction has nowhere been repaired in the last month. So I would say within 10 to 12 Ks of the CBD, Sydney, Melbourne, houses definitely, because these great results we've been seeing have not really led into apartments as yet, right? Then I turn to, so I think Queensland is a different kettle of fish, because Queensland meets this. It gives you some capital growth and it gives you decent yields. So if you're the sort of person that says, hey, I want to get good rent and I want to sort of get, decent capital growth, right? You probably won't get Sydney, Melbourne capital growth, but your curve is not going to look like that in capital growth. It's going to look like that, but you're not probably going to get what Sydney and Melbourne copped in the last 2 years, because places like Brisbane and Adelaide have been steady. Hobart's been a ripper. Just surprised everyone. It's been gone gangbusters. So if I'd be looking for capital growth, I'd be looking at houses, Sydney, Melbourne, within 10 to 15 Ks, and if could, I'd wait a little bit till the stock levels go up.
Okay, one last question, mate, and you brought it up. You hinted about apartments, and it seems to me there's probably 3 issues that I think about. A, oversupply in some areas. B, the fear of structural problems. And secondly, these cladding issues. Are all these things holding back apartment buyers because there's a bit of anxiety around all those issues?
So, Peter, the first issue, which is demand and supply, that you could always replicate, build other units down the road, was an issue, that there'd be an oversupply when it comes time to sell. The other two that you brought up, cladding, and problems, they're a phenomenon that have been front page of Fairfax and News Corp media now for the last 6 months quite often. And that is a concern because real estate is about safety. Insurance companies exist because of safety. Now, if you're sort of reading stories, both in print and online, that is affecting the biggest asset that you're going to invest in, that is going to affect your behaviour. So I think you're absolutely right. I think it is affecting it. And I'm noticing that there's a trend where instead of someone buying a unit in the suburb they'd like to buy, they'll go off further out and buy a house in not as good an area, but they know that they're not going to have those three issues. Example, you might not buy a unit in Marrickville, but you'll go out to Canterbury and buy a house.
Yeah, okay. And it is, but I guess there's probably an opportunity there that there are some really well-built apartments that may well be selling at good prices because the market's really apprehensive at the moment.
Absolutely, and I think that's where the real value comes in if you're buying, that if you actually put the time in to your research. Like holidays are coming up at Christmas. This is the time when people actually book where they're going to go spend Christmas. If you actually spend your time planning your next purchase as much as you're planning your holiday, you'll look into information that will actually say, hey, this product's a good product. The Strata report shows that there's no problems. It's got a history of very happy owners. You might benefit because other buyers, like it's got to have you got to have the courage to actually buy things when others aren't buying because they're scared. You know much about.
Well, Warren Buffett said, "Be greedy when everyone's fearful." There's great opportunity.
Correct.
Tom Panis, thanks for joining us.
Thank you so much, Peter.
Great to see you, mate.
Thank you.
That's Tom Panis from News Corporation. And what's your website, Tom?
Realestategym.com.au.
Great stuff.